Hello, in this lecture we're going to talk about supply and demand, chapter 4, and we're going to start off with our quote from Thomas Carlyle, and the quote is, "Teach a pirate the terms supply and demand, and you've got an economist." So I think that's actually a bit self-explanatory and pretty clever quote there, so we'll move on to supply and demand. Chapter goals will be to state the law of demand and distinguish shifts in demand from movements along the demand curve. State the law of supply and distinguish shifts in the supply from movement along the supply curve. Explain how the law of demand and the law of supply interact to bring about equilibrium. Distinguish the limitations of demand and supply analysis. So this is, of course, the lecture that comes to most people's minds when you think of economics. So if someone says economics, someone's going to think supply and demand. They're probably going to think of this chart. So we're talking about the demand curve, the supply curve, the interaction between the demand curve, the supply curve. Much of the modeling and the basis of future models are in relation in some way to these concepts. So the law of demand states that the quantity of good demanded is inversely related to the good's price. So what that means, in other words, is other things equal, holding all things equal, because we are talking about a model here, and we're isolating our factors to just have these factors involved, and that's a scientific method, by the way. Quantity demand rises as price falls. So all else equal, if the price of something goes down, then people want more of it. And that seems somewhat self-intuitive. There's going to be exceptions to that at a later time. There are exceptions to that rule, which we'll talk about at a later date, but the general rule being that when the price of something goes down, people will want to consume more of it. Quantity demanded falls as price rises. So as the price of something goes up, then the quantity that people will want of it will generally go down. As prices change, people change how much they're willing to buy. So this is going to be the assumption we will have. Prices do affect how much people will want of things. And the law of demand is based on the fact that when prices for a good rise, people substitute away from that good for other goods. So note that if the price rises, then you're going to say, well, people are going to buy less of it. Well, that means that people are either doing without that good because they're demanding less of it and they're buying less of it, and or they could buy a similar good. So if we rise the price of donuts, people might buy Danishes. So we could substitute the goods, and that's one way that this law of demand could work here. So the demand curve. The demand curve is the graph representation of the relationship between price and quantity demanded. Note that we have price here on the vertical axis and quantity on the horizontal axis, and the demand curve will slope downward in this way. And what this shows pictorially is what we just discussed in words, that being that a price increases quantity demanded. So if we're at this point in time, at this particular price, of course, this will be the quantity demanded. If, however, the price goes up, so now the price is more, notice what happened to the quantity demanded. It goes down. So this is us moving along the demand curve. Notice we have a simplified model here. The only changing factor here is price, and we're seeing what that changing factor of price is on the quantity demanded. So we're isolating the factors, and we're trying to think about just those two scenarios. Now we will introduce other factors other than price, and we'll look at the difference between moving along the demand curve as we're doing here and shifting the demand curve when we take into account factors other than price. So shifts in demand versus movement along the demand curve. So quantity demanded refers to a specific amount that will be demanded per unit of time at a specific price, all other things constant. So it refers to the specific point on the demand curve. So the quantity demanded, specific point on the demand curve. A change in the price causes a change in the quantity demanded. So as we've discussed, if the price changes, the quantity demand changes, and that'll be a movement along the demand curve. Now we're going to contrast this term quantity demanded with the term demand itself. Demand refers to the schedule of quantities of a good that will be bought per unit of time at various prices. So now we're talking about the set of quantities at various different prices, other things constant. So now we're looking at basically the curve itself refers to the entire demand curve, not just one point in time. Demand tells us how much will be bought at various prices. A change in the quantity other than price that affects the demand curve changes the entire demand curve. So now we're talking about if we change anything other than price, then we're not talking about the same demand curve now. We're shifting demand curve. The demand curve will have to shift. A change in the entire demand curve is a shift in demand. So shifts in demand versus movement along a demand curve. If we look at these concepts in terms of the demand curve, remember what we have here is we got our price on the vertical axis. We got our quantity on the horizontal axis. This could be any good that we're talking about here. And at point A, that means the price is $1 and therefore we're going to sell 200 units of it. A change in the price causes the movement along the demand curve. Therefore, if the price goes up to $2, then we're at point B, which means that we're gonna have demand of 100 units. So a change in a shift factor causes a shift in the demand curve. So this would be anything other than price. We'll have a list of some of these things that could be other than price, but obviously if we had more people in the population, that could shift. If we had less people in the population, now we're talking about things that will definitely affect the quantity, even though it's not the price that is affected. So if there's something other than just price, and we're looking at price in terms of the price's effect, or what will the effect be on the quantity, and we look at something other than price, then there's going to be shifts along the demand. The entire demand curve will shift. So in this case, we're going to shift it down, and that means that something else happened. Maybe a decrease in the population happened. And that would mean the entire curve would shift inward. So at point A, now there was a decrease in the population, let's say, and at the same $1 unit price, we have only selling 150 because the demand curve shifted inwards. So important demand shift factors could include things like society's income. So if for some reason the overall society's income goes down, then that could shift inward. If the society's income goes up, then it could push outwards because we would assume that people would buy more stuff. The prices of other goods. So whether those goods be complementary, such as like condiments to a hot dog or a hamburger, you can think they're going to be sold at the same time, or substitutes such as a donut versus a Danish. Those things could have factors. Changes in those prices could have factors in terms of shifting the demand curve. Tastes could change. People could just over time have different tastes in societies, and these could change drastically if there's something like a health news out there saying there's always this debate on, are eggs good for you or bad for you? And when the health people come out and there's a health report saying that eggs are bad for you, then tastes suddenly change. And if they then say that they're good for you, then they could change the other way. Expectations could change. So if there's future expectations of what will happen, people will act on those expectations. Taxes and subsidies could change things. So of course, taxes are going to be a cost that is going to change things. Subsidies being the government subsidizing or putting more money into a certain thing. And of course, that could have the effect on the demand being shifted rather than being movement along the demand curve. Notice these are all factors, once again, that are something that's going to change the demand curve itself because there's something other than just price. If it's price that's changing, then it will change along the demand curve. If it's one of these things that are changing, the demand curve itself will shift.